Good morning, everyone. Welcome to the room. As you know, trading futures does involve risk. It's not suited for all investors. Information in the presentation is for educational purposes. It's not a trade signal service, not intended to be financial advice. Hope you're doing well this morning. We are off and rolling. And the first things I like to do that I actually forgot to touch on in yesterday's analysis video is take a look at the unfilled gaps at the start of the day. And you can see yesterday's, I left these up because I wanted to show you we came up and closed the unfilled gap from back in February. And then obviously we filled Friday's gap right away yesterday, and that's about where we closed. We're going to have a small gap up today. I'm going to go ahead and mark today's close on my gap chart here. And then only one more above us, 44.56. Oops, sorry, that's yesterday. It is a 40.59 1/4 is the only unfilled gap above us. Technically, that's well, no matter how you look at it, it was either was it MLK Day, yeah. So I don't really count that day. So the bigger move was the gap down on Tuesday. But nonetheless, there's an unfilled gap up there, and then down at 41.7250. Taking a peek at our trend line here, just a clean break in the ES. Gotta say I'm a little bit surprised. I thought we'd get a little bit more of a sell-off, especially when we came up to this swing high here around 4,400. But she ain't stopping. If we go to the retracement, which we talked about yesterday, ES is sitting right at that halfway back. I did put a small put position on at the close yesterday. I was hoping we could close a little more bearish, but nonetheless, even if we get a pullback to the halfway back long, which I think we'll get a bounce at 4,300, 4,312 is the exact 50. Getting a move, kind of riding a move down to that point is often a good play, especially when you're at a negative 23. Let's say this was a long and it lined up. We'll just pretend it's like this. And let's pretend that we're at the 50% short, the yellow line, the large 50% short here, but we're also at the negative 23, which is a little bit of an arbitrary target. It's a fib retracement, 23.6, but essentially it's just 20% beyond highs of wherever you had your anchor point to. So anytime you're at that target, it's also a good place to look for a counter trend trade. So if it's a long coming into a negative 23, then you could look for a short. If you're moving down, you're already short into a negative 23, then that's where you could look for a long. I'm not always out searching for a counter trend trade. Sometimes there's just not an entry into the trend early on, or other times I've taken a couple of trades with the trend and now we're starting to slow down. The distance, like each of these candles, if you look at how much we've made a new high. So down here was the high, and then the next day's high was a little bit higher. Then we gapped up and we went from like 42.60 all the way up to 43.60. 100 points was the difference between the highs. Next day, about the same. Next day, about the same. Now we're getting a little bit, that distance is shrinking between the highs. And then let's say we already put in the high for the day. Okay, then it would get really, a lot flatter and sort of roll over. So those are some of the indications that, when you have these moves that go straight up, they start to flatten out a little bit. The trend line becomes less steep, like if we were connecting it straight up, then it would become a little bit more shallow, 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 and then roll over. Now we are at risk of a bull flag where we're moving sideways, but typically the flag portion of the bull flag is more within the first candle. So like back here we had a big body candle. Next candle was also a big body, meaning the high and the low were not much outside of the open and the close. That makes the body really big. And then look at these next three candles. Most of the trade occurred within the first candle, like this. It all occurred kind of within that. Then we poked above this flag, and then we turned around and failed. Anytime you go above a bull flag like this, like you move above, you could also look at this as the 30-minute high and the 30-minute low. When you break above, and then you fall back down and trade inside of that range, there's a good chance you're going to the other end of the range. So as we are in now our, let's see, 1, 2, 3, 4, 5, 6th day of this run-up, where we have not broken the prior day's low. That's also another signal that I look for. When you break the low of the highest bar in the rally, you're essentially breaking the low of the high bar. That's a good potential rollover signal. And conversely, when you break the high of the lowest bar in the pullback, high to low bar, that's a good starting to break out signal, or starting to reverse trend signal. You're breaking out of the individual candle, but it's not so apparent. Like, let's say you got long above the high of this bar here. The downtrend at that point, just the small downtrend here, would be maybe something like this. When you have a gap up and we sell off back into the prior candle, if you just kind of do something like that to give you a look at where we close, like connecting the closes, I feel like the closes, I don't feel like that the closes do have more weight than any other point in the day. We can make a high, and then if we sell off and prices agreed upon 50 points lower, the high is going to be fairly weak, and we're not going to have had a lot of trade at that level if you're looking at like a market profile chart or something like that. So you look at the trend line here, and you get that first little break of the high, and that starts our move up. The trouble down here is, since we were in this triangle, we had a lot of little false breaks, if you will. We moved down, and then we came up, we broke this candle's high, but then we traded lower, put in a little bit of a higher low. Even this guy here gapped up and then sold off. So triangles can be a little bit dicey to be swinging inside of that. When I say triangle, I just mean like the lows are getting higher and the highs are getting lower, so it forms a bit of a triangle. The breath I've been watching as I've been speaking here, it's actually getting a little bit stronger from where it was at the open. So, yeah, we'll see what we get. I would typically, if I put on a put position and it goes against me the next day, or we start to move up towards the 61.8, I'll go ahead and close it out at the close. I would be inclined to hold this another day, maybe two, maybe take it to Thursday, just because it was a little bit of a smaller put position, and I did that because the distance between the 50 and the 61.8 here is pretty big, so didn't want to over leverage myself. And even though it seems as though the market should be rolling over here, I don't want to just infer what I think the market should do and get so stuck in that and say, oh, the market has to go down. We can't go any higher. Or if the market is, you know, in a downtrend, saying, oh, well, the market it has to go lower. We're for sure going lower, and I'm going to load the boat short. Or the market can't go any lower, and I'm sorry, I'm going to load the boat long if I think the market can't go lower. So you want to really focus on what you see, what the chart is telling you. As much as no matter what I think, when I look at this chart with the trend line on it, we've broken that downtrend. We've broke that downtrend. Even if I came in here and I say, well, let's bring this up and just connect to this high. It's we only have 2 touches at that point. Still broke the downtrend. So trade what you see, not what you feel. Let me go to a 5-minute chart for a minute. Get rid of this halfway back from yesterday. So one reason I like to wait till the close to put on a put position or put on any kind of like swing position, waiting for those last couple minutes of the day, 5 minutes or so, ensures that, let's say, instead of rallying at the close and those put contracts that were, $3 are now $2.50, like they've gone down in price because the market went up. Let's say we actually went down and they were 3 and then now they're $3.50. Well, when you're putting it on at the close, you don't have much change in your price between when it closes and when you put the order in. So that way, at least you're kind of coming in to the position flat overnight versus like if I put it on, if I sold it, if I bought the puts down here and then we rallied and then I'm underwater already at the close, yes, I could maybe be in a situation where I bought them in the middle of the day over here and then we closed lower and I had a little bit of gain, but by and large, that little gain on the day is not going to make your position. It's more about, protecting yourself from a bigger move. I don't really care about a little small move. If I, bought the contracts for 3 and I close them out for 2 because we keep going higher and I have a, $100 loss per contract, whatever, because when we have that bigger sell-off that I'm protecting against and they go from 3 to 13, then you're making $1,000 per contract. That's what they're really there for. Like you got to ask yourself, what's the purpose of them? Well, it's not to just take a couple of bucks. It's to protect myself. If things really go south, if the market goes up, then the long position will cover itself, cover the cost of those puts and then some. So you don't want to just always have a long and short position on at the same time to where they cancel each other out, but strategically putting them on and hedging your risk is certainly a good strategy, especially when volatility gets low like this. Let's take a look at the VIX. Last night, we came down to the trend line, and we're already kind of dipping below the trend line, which is, again, very surprising. At one point yesterday, we had kind of rallied in the afternoon, but that's why it's important to wait till the close to assess the daily chart, because at 12 in the afternoon, middle of the day, this could be a hammer. And then by the time we get to the close, it's a bearish bar. Right now, this candle is a big body move to the downside. Looks bearish. Well, if things start to roll over in the broader market and they go down and the VIX starts to go up, we could close with a big bullish bar and it could break the high of the prior bar. So you could spend a lot of time analyzing the daily chart intraday to no avail. And all of that analysis doesn't end up really mattering. Good question, Paul. So when I say 5 minutes before the close, I'm referring to like the NYSE 4 p.m. close. And that's a good distinction because you're not going to be able to put on a option position unless you're trading after hours, essentially, beyond that. But the futures markets trade that extra 15 minutes. It's like here's the 4 p.m. close here, but then you get this 15 minutes of settlement, and that's what I use as the prior day's close, is the settlement of the ES, that 4:15 Eastern time. All right, so I'm watching as we come in here. 15-minute bar would be a go, or 15-minute trade would be a go. And we are currently looking at an 83.50, but we've got another minute and a half. The only time the 15-minute trade gets a little bit hard to put on is if we close at the high or the low of the bar and we are moving. So if we close at the high of the bar and then the next candle forms immediately 6:45 or 15 minutes after the bell and then keeps going, sometimes unless it, I mean, sometimes you're kind of dropping your price, dropping your order on the price. I'm still using the, um, I'm not just hitting buy market. I'm still putting the order on the price ladder. But there was only two instances I can think of where it moved so fast that by the time I went to drop my order, we were already another point higher. So I just sat back and I just let it go. So 83.50 still is our high. So I watch that clock, 83.50. Okay, I think we'll be fine. And 83.50. So 83.50 is the high, and then I come in, look at the low. I already have the 83.50 order there resting, and the low is a 44.67. So then I just round down or moved it down a tick, 44.66.75. Plenty of time to drop that in, and we're good. So then I just leave those in, and then we can look to other halfway back trades. I've heard a lot of people are doing this, doing both on the ES, but trading halfway backs on the micros as they sort of get a feel for the retracement style of trading, and then trading the 15-minute breakout just on the regular mini. And then you only need one account. Otherwise, you would need two accounts to be long in the mini and then short to halfway back in the same mini. Or if you were long and you also had a long in the 15-minute and then long on the halfway back, you'd kind of be double long. As I said in yesterday's video, I like to lean on the 5-minute by drawing up the retracement, not putting a limit order there when I draw it up on the 15-minute. Instead, use that as sort of your first level of confirmation, and then take the trade on the 512 tick chart. And we are pretty early still, so we don't have a lot of nicey tick data as far as highs and lows to go off of. When it's 10, 15 minutes into the day, every time you come down and make a pullback or a rally, you could be making a high or a low tick. Not much for news today. Later in the week, though. For that 15-minute, I've sort of done away with the 4-point target just because the winners are so big that if you're there every day taking it, then I'd rather just have more contracts as runners or more contracts reaching that 20-point target. So 4-point stop, 20-point target, and you can basically walk away and then just come back and check on it and adjust your stop as needed. But there's really not much hands-on happening with that one. we're awfully close. Well, what does that say? Oh, I thought that said 78. Yeah, it does say 78. So we came 2 ticks away from the short. That's why I didn't draw up the long here. I felt like we're more ping-ponging between the 50s at this early juncture, and the swing high was just 1 tick here. Breadth and advanced decline line basically about the same as they were. Let's take a quick peek. Paul asked a good question yesterday. Um, in the video comments about the relative strength and weakness. You can, from a daily perspective, when you're looking at the relative strength over time, you say, okay, S&P is at the halfway back here, but then the NASDAQ is not at the halfway back. So over time, this shows the relative weakness in the NASDAQ. But if we go to just today, and we look at S&P Dow, Nasdaq, Russell, we can see, okay, the Nasdaq is the weakest as far as it's up the least. So just looking at that percent change is a helpful way on the day to get an idea of what's strong and what's weak. But the day can fluctuate a lot more. You could be and at this point they're all pretty close. So you want to be looking at the kind of relative strength over time. Not in a super low tick here. Kind of came up close to highs and then didn't really drop down into a low tick. As you go about the day, it's helpful to kind of keep the most recent or the last retracement on the chart. So like I'll keep this 5 minute up on the chart until we either break the 61.8 or complete the negative 23. That's why I keep it as a reference and I know, okay, well, we're retesting that 50%. We didn't make it into new highs or break to the negative 23, make it to the negative 23 or break the 61.8, but I'll keep that up on the chart. So sometimes you'll see, for those that are newer to the live stream here, sometimes I'll have a retracement up. Like right now, I would draw the short up. I'm not taking it, but it's sort of the most recent retracement, and just keeping that on there as a reference as, okay, here's the 61.8, that's the failure point. We're in this kind of bull flag, haven't come down and filled the gap, not able to break above the first 15 minutes yet, so pretty tame and a pretty tight range relative to what we've seen. Eight points or so. Another thing to keep in mind is on the daily, on the ES, we are at that large 50% retracement short. So there's sort of longer term sellers either putting on or looking at putting on short positions here just because it's a big halfway back. And so there's a couple of scenarios that can result. If the position is big and there's stops above highs, you can end up punching through highs and moving really quickly, but you could also, every time you go into highs, which we haven't done yet today, we haven't moved outside of the first 15-minute bar, but let's say we do move above the first 15-minute high, and then we're immediately fall back in. And then 10 minutes later, we break into new highs, we go a couple of ticks, and we fall back in. That's a signal that there is selling pressure that's strong enough to hold us down. So how we react when we break into new highs and new lows, those are all sort of subjective observations that you really just need to focus in on one market and really get to know those patterns that the market is making. And it does take some time, but if you wanted to be a doctor, you'd be in school for years on years, lawyer, doctor, even an artist. I mean, you think a musician, you think of all the hours spent mastering your craft. Um, Even the trades, carpenter, plumber. Yeah, anyone can, most people can hammer in a nail, but just like most things, there is an art to it. And trading is the same way, even though we try to be as mechanical as possible and be very objective and lay out, strategic plans. There are these nuances, especially when it comes to relating multiple, I guess, indicators or signals together. You're looking at a 5-minute chart and a 512. You're looking to the left of the chart and saying, is there any support to the left? Okay, well that's fairly objective. No, I don't see any trading in the last 3 days to the left of where we're at now. But let's say we come down, you say, okay, well, here this looks like it could be a support level, 44.63. Well, it could also be, more of a support zone where it's 60 down to 65 to 55, something like this, a support zone. And so there's some open for interpretation, I guess. And that's where leaning on the nicey tick is really useful because we can be validating our longs and shorts with high and low ticks. And I should have had that drawn up a little bit quicker, sorry. Would have been a 44.79 and a quarter. VIX has definitely come way down since a week ago. Mid 30s to low 20s. That's quite a drop off. If we came down and broke 19, it's like just below 20. That would be quite a surprise. And likely to catch people by surprise. It's not as shocking when the VIX is shrinking versus when it rises as far as the reaction to the market. When the VIX goes down, volatility is less, then the ranges are smaller. There's not as much movement. Well, when the VIX is up or going up, you have a lot more price movement, and that's what initiates the fear. Breadth pretty strong here, 4-1, and advanced decline line holding. Everything is showing bull flag. So we'll see how strong the break is to the upside if it indeed happens. There it goes. Let's see how we do. Not very violent at this point, or yet. Okay. I'll put a line here so we can see that 15-minute candle high, which is also the 30-minute high. And we'll see how it does. This 79.25 also a fine place to put on the entry. We did have that low tick. I didn't have it drawn up as quickly as I should have. I don't love when the anchor point comes close to highs, like we came 1, 2, 3, 3 times up here, close to highs. It's nice that it didn't touch and make an exact double top, but it did come close. But then you look at the things like the breadth and the advanced decline line. Okay, are we very bullish or are we bearish? The only thing I would do is watch for a move to 93.50, and then I would just move my stop to break even at that point. Otherwise, just a lot of sitting and waiting for that 15-minute before there's much to do. You wouldn't move your stop underneath this candle's low. I mean, I guess you could. It would be 83.50 would bring you down to a 79.50, so it would bring it up a point, but I typically don't move my stop until the candle's low is above my entry. So I'm actually moving my stop above the effectively the break-even point. So otherwise, not much to do there. Well, look at this 5-minute here. See how we are at the negative 23 of this 5-minute. That's why it's important to leave the drawing on the chart until we either complete or break the 61.8. It's also worth noting that, yes, you can take trades off of the 5-minute chart if you didn't even want to look at the 512. But if you're going to do that, you really have to play with the ratios, and you want to have a stop below the 61.8, which is oftentimes bigger than 2 points, and then just target the negative 23 and don't have a lot of micromanaging of the trade. So at this point, my stop on the 15-minute trade is just at -4, and I will, unless we get to 90, what did we say that was? 83.50, 93.50, a plus 10. I've just been arbitrarily moving it to 0 just because 10 points is a decent move in most situations. The last couple of months we've had higher volatility, so it doesn't seem that big, but at least as a way to reduce the risk. But if you're going to trade off the 5-minute, let's say you're just going to put an order at the 50% here, 75.50, and your stop goes out, we'll just say 72.50, so it's like a 3-point stop, and you're going to target the negative 23. You can't be coming in here and trailing your stop like we would on the micros. You have to just leave it alone and let it go to the target. And that can be hard to do, for especially for a lot of newer traders, and you have to be there every day because you don't get as many trades on the 5-minute setting up, and you have to take all the setups whether you think they look great or not. So on the one hand, it might sound a little simpler because there's fewer opportunities, it's a larger time frame, but on the other hand, when you can get a first target or reduce your risk on the trade somehow, then you can oftentimes stay in the trade longer. But it doesn't do you much good to get out at, a point when you did all that work and analysis to get into the trade and it starts moving your direction, and then you get out right away. Our breadth is actually 3-1 now. I swore it just said 4-1 um, 2 minutes ago. So we've actually moved higher, and the breadth has gone down, unless my eyes were playing tricks on me. And this is another, this is why trying to pick tops and bottoms and get in and get out of swings, or like a longer term 10 plus year position, long term position, is not as profitable in my experience. I guess I don't have a lot of experience trying to sell my entire retirement portfolio at the top and then buy it all back at the bottom. But if I thought, oh, we're things are scary, I'm going to sell my whole 401k, or I don't have a 401k, but if you thought you were going to sell your 401k and your retirement account because you didn't want the market to go down anymore, and then you rally like this, you never know what can happen. And you'd end up just selling it at the lows or close to it, and then waiting for it to go lower, and it doesn't go lower, and now all of a sudden you're sitting up here and you're stuck waiting, letting it roll over. Well, if you did that in 2020, you'd still be waiting. I'm going to draw up this next retracement on the 15-minute here. Let me go to a 5-minute so it's a little easier to see. 15-minute, 5-minute, they're basically giving you the same information. Just the 5-minute gives you a little bit more to glean in between the candles. Like we can see these long tails here. And so this 15-minute or 5-minute, whatever you want to call it, 44.8250 kind of lines up with highs of the 30-minute high and that 15-minute high. So that's a good looking retracement. Tick's still kind of in this downtrend, making lower lows, but actually making higher lows on price for the most part. So that's why I'm not sort of aggressively trying to short any of these halfway backs here that just sort of ripped right through. Because we didn't really come up and break this downtrend and form a relatively high tick. Now reading 2.7 on the breath. So definitely coming down from a volume perspective. Still well off that next 50%, but I guess it's only 5 points. It feels a little bigger, but kind of in the early stages of another bull flag possibly up here. Let me see if I can make this bigger. I'm going to get rid of this first retracement just because we know we're kind of hugging along the negative 23. It makes the chart a little bit cleaner. I like not having too much on the chart so you can see it for what it is and you're not just looking at a whole bunch of lines thinking, oh, well, here's a support level. The market must stop at this line or then the next line and the next line, and you just end up getting burned or sort of tricking yourself into thinking that there's a stopping point when there's not. At the very least, okay, having one retracement drawn up and looking, okay, the 50%, I'm not just seeing it as a line, where does it correspond with other price? Again, if you were looking at a market profile or a TPO chart, you'd see, lots of price at this area, 44.80 to 82. So that's what's giving you the support, not just some arbitrary yellow line on the chart. And when you get these tails like this, it definitely sort of signaling that the buyers are, every time we get sold off, the buyers are coming in and pushing us up. So likely we can continue going up. Yeah, another new high here. So when this happens, when we come dip just a tiny bit, not even anywhere close to the 50%, let's draw up that first retracement again, and we'll take a look at this negative 61.8 as the possible pullback point, 44.93 area. But it doesn't make sense to have this retracement up here, the second one, when we're still sort of moving higher from the first. Bitcoin getting a bit of a leg up. I'll go to that chart quick. Making its way towards that 45 kind of. We did break this swing high here within the triangle, which is noteworthy. So that one looks good. Now something like that, a Bitcoin swing would be one where I'm okay getting in and getting out with a position as opposed to buying and hold. I mean, you could take that approach if you just wanted to accumulate some cryptocurrency and ride out whatever waves end up happening, boom and bust cycle, stuff like that. But you have to ask yourself if you're going to be in and out. It's getting kind of small up here. These are not really anything too exciting to take a retracement long up here. Let's just let the 15-minute work its way. But if you're going to be like swing trading an individual stock and you're going to buy 10 shares, you have to relate that to your entire position. If you made 10% return on those 10 shares, how does that 10% relate to your entire portfolio? You can't have, $1 million portfolio and be trading 2 Tesla shares and have it make much of an impact. So when you're trying to determine, oh, well, do I just, buy and hold and let this position grow and grow the position in addition to letting it increase, or do I try and get in and get out and get in and get out and make 1-2% here and there, or 10% or 40% on one swing position? Well, when it relates to the bigger picture, the numbers or the amount of the size needs to be big enough to make an impact. And that's where, like, trading the micros, yeah, they can be an effective way to learn, but you're not going to be trading micros 5 years from now. The idea is to grow into the minis, and you don't have to be trading 20 contracts, but trading a handful of contracts does open a lot of doors. So not really much to do as far as, in my view, tightening a stop here. I like to just kind of leave things alone, especially at the early stages. Haven't even made it that 10 points. In the early days, I was doing a +4 first target, but when I went back and looked at all my trades from last year, it just, yeah, you catch an extra +4. Let's say we sell off here and we come down and it kicks us out of the trade, then you ended up with +4. Well, that's great, but you miss out on those bigger winners when you're getting the +20s. A +20 makes up for 5 trades where you took a +4. So if this thing rolls over, I'm more apt to just get out. It's like I'm willing to give up 4 to possibly see 20. So always thinking in terms of ratios. Let's look at. Man, we're not even near that. I was going to look at a little counter trend trade in here as a short, but it's almost like we could draw. We didn't make it all the way to the negative 61.8. Drawing the full halfway back, it's kind of early. Well, I guess it's 45 minutes after the bell. Maybe at the hour mark, seeing a move to the full halfway back, but that is below the top of the first 30-minute range. So that would mean we would fall into the first 30-minute range and likely go down to lows of the day. So I'm going to draw a retracement like this and see if we can move down to it'd be an 83.50-ish. I know it seems like kind of a slow morning, even though we've got this 15-minute trade going, but advanced decline line has come down. They're both still, breadth and advanced decline line, still fairly bullish, but always looking that relative strength and weakness, as I was highlighting yesterday. That can be looked at as, okay, how is Tesla trading compared to the S&P? Okay, we look at the prior swing high here, here, and the swing low here, and then we go over and we look at the S&P and we say, okay, well, it's pretty much the same. The swing high, maybe Tesla's a little bit more bullish, and the swing low, but by and large about the same. And then we look at, okay, where are we in relation to the breadth from 15 minutes ago? Well, we're a little bit weaker relative to that 4-to-1 that we were at. So we're kind of coming down. The ticks are still drifting lower. They're starting to get into, not into extreme. A plus or minus 1,000 on the NYSE tick is more of an extreme. A plus or minus 800 is definitely noteworthy. Um, 5, 600, yeah, relative to what we've had today, is fairly bearish, but or fairly low, not really bearish. But even if you drew a high-to-high extension, it doesn't really give you a launching point here. If you want to say we broke the short, so that's one good thing about today, staying out of trying to short. And it's maybe I think the fourth one now that has set up or at least broke the swing low back here and did not find that a valid short. So if we can get to a 93.50 at the very least, you can move your stop up to break even or +1 if it makes you feel better. But you can at least get to a free trade and then see what happens from there. On this particular candle, if I go to the 15-minute chart, the next sort of stop moving place, moving of your stop, would be under, let's say this candle, the low is already in at 80. Hang on a minute. Let me move my stop up. Okay, so I'm going to go to break even on my stop. If this candle closes and the low of 85.25 is already in, then I would move my stop up to 44.85, one tick below this candle. Otherwise, if we can get to 03.50, then that 20-point target will just get hit. So again, we didn't make it down to the 50%. Get rid of that. And it's almost canny how much when you get a 15-minute trade that's sort of chugging along, I end up with fewer retracement opportunities. But then, like yesterday, the 15-minute, we filled the gap in the first 15 minutes, and then there were more retracement opportunities. Yesterday's 15-minute did go for, if you would have done it and trailed, maybe like 4 points, but by and large, those ones that fill the gap end up being stop outs. So don't forget, don't look at one trade and say, oh, well, I could have came away with 4 points on the day had I taken it. Well, don't forget about, the other 10 trades that would have been -4. So even if you would have came away with +10 on the day, you have 10 trades with -4 that give you a -40, so you're net negative. Now making it to that -61.8. I like this jump in the nicey ticks, but our swing low is technically down here. And drawing this as a long after we've moved up like this, I do like that it's sitting on top of these 50%. If this was like my third retracement or fourth retracement on the day, I'd be more apt to jump in, but because I got that 15-minute going, I'm less excited about it. 90.25. We really haven't had any pullback today, and we're coming already to the hour mark. So I'll leave this drawn up here. I don't have a 90.25 sitting out there. So continuing our just new highs on the day. Let's compare our NASDAQ breadth advanced decline line. 3 to 1 plus 2,000. These numbers are not directly relatable of the advanced decline, but the breadth is. So NASDAQ now, if we look at it, stronger than the other two on the day, S&P and Dow, but on the bigger picture, not quite so much. NASDAQ getting not a lot to do there either. And it's okay not to have 20 trades a day. I know sometimes it's not the most exciting for a live stream, but I mean, if this thing just slowly works its way to plus 20, there's not much more I could ask for. Take the profit, go ride my bike, go play with my kid. I mean, it's pretty ideal day. As far as going circling back to that put position, if we came up to the 61.8 and closed like a big inverted hammer bar or some big bearish bar, I could be talked into, either adding a put. More often what happens is, like, uh, let's say we closed just like this today. We opened at the low and we closed at the high, and I closed out the put position. So just take a little bit of a loss and walk away. Then if we come up a couple days later and form a bearish candle and we're still within the 61.8, then I could put it on again or put on another put position with a higher strike with more time because I'm putting it on at a later date. I would be more. That's typically more the style that I would use as opposed to saying, well, I bought puts down at the low and I've got 3 weeks, so I'm just going to hold, and just let them go to nothing. Like I'd rather just like, well, perfect example, putting on the was here on the 9th, and then we closed bullish on the 15th. I was basically back at my break even, and so I kind of by the numbers I had to just close it out, and I figured, well, if I get another opportunity, I can always put on a new put hedge, but we closed bullish off the Fed meeting, and then the next day bullish, next day bullish. Okay, well now I'm up here buying puts with a 442 or 40 or actually it was the Nasdaq 33 or 346 I think I had, and so now I'm up here with a strike as opposed to having a strike down here and having 1 day left. Now I'm up here with 2 weeks left. So, and they were a lot cheaper because volatility's come down. So you don't need to overcomplicate it as far as hedging goes, but leaning on that chart for trading what you see, like we mentioned earlier. So we got one more minute and we'll be able to bring our stop up unless we scream lower and make a new low on this candle here. So let's look at that price. It'll be a 85 even. So not much of a move. Just 1 3/4 points, but at the very least it locks in that small winner, and we continue to wait as we grind higher. So there we go, 80, 44.85, and we just wait for that next leg up. But the nice thing with puts is that when they go your way, because you're gaining when they go down, volatility is going up, and that inflates the price when in your favor. When they're going against you, yes, volatility goes down a little bit, but you know they essentially are going downs in price against you, kind of at a slower rate than they do if the market sells off and they pop. So that's, I mean, you could sell, I guess you could like sell micros below the low of the high bar and hold them, to the next expiration and roll them over, or just use the next expiration as your, I mean, even if you use the existing June contract, and you can kind of swing trade micros like that, but there's going to be very linear. If it goes up 50 points, you're up. If you go down 50 points, you're down. Whereas with puts or options in general, it's more of a kind of a curve. Inching our way here. 97.50 is the high. Nothing really for news yesterday and today. Later this week, especially Thursday, some news, economic news announcements, but kind of quiet to start the week. See how we left the 30-minute range? That's what this 83.25 represents, the high of the 30-minute range. And we did not come back into it. That is a signal that we're going into a trend day. And that was what 5 minutes after. So how we break into new highs or into new lows is very telling, especially when you have kind of a clear line in the sand. So had we pulled back, maybe dipped down into the first 30-minute range, and then rallied, we would have likely seen resistance at the top of the first 30-minute range, and then you could place a short and try to make it to the bottom of the range, and then you're sort of ping-ponging back and forth. So trying to keep things as simple as possible with your, trade execution. And if you are looking at multiple markets, I mean, you can't have 10 different strategies that you're trying to do across different markets unless they're, you know, kind of a well-oiled machine. If you're looking at retracements across a couple of markets, even that, if you're trading ES and NQ, it, it still takes a lot of concentration. And I apologize if I miss setups every once in a while with trying to kind of narrate what I'm seeing. So we need to get to an 80, or I'm sorry, a 0350 to get that, really an 0375 to get the fill. Otherwise, we've got to wait another 10 minutes, and the current low of this bar is actually pretty high. It's a 94.25, so a 94 if this candle holds and the low is already in. So I suppose that's the hardest part about this 15-minute breakout technique is just the waiting. And if you have to get up and walk into the other room and uh, pour yourself another cup of coffee and walk back just to kill some time so you don't do something stupid, by all means. Once you're in the trade, there's a lot more hands-off than hands-on. And we used to, when I was first kind of learning futures trading, I'd been pretty consistent with swing trading at that point. Volatility was lower. This was in like 05, 06. And then getting into like 07, 08, I started futures trading, day trading. And we would put our target 3 times our stop, minimize the trade ladder, and literally just kind of sit there on our hands and just use it as an exercise to, a little double top up here, use it as an exercise to build the mental patience. I'm going to get rid of these, and we're getting smaller and smaller as we get up here. This little double top is intriguing, but you don't just want to be picking a top like we said earlier because, the market can't go any higher. Well, the market can always go higher. Well, if you're, so as far as minimize the trade ladder, I think you can disconnect you can like set it if you're trading on toss so that your trade ladder prices don't show up on the chart. Or if you're using the active trader, just you could flip over to a regular chart like this, I suppose. But the idea is you're just not staring at, the dollars. Getting a little toppy up here. Double top, breaking the swing low. Right at that 4,500, so a big round number. That's not too shabby. What do we got down here? So this first 5-minute traded, and then we went pretty much no pullback on the 5-minute, which is kind of corresponds with the 15-minute trending without a pullback, which is that was the whole premise of developing the 15-minute strategy. Hey, I'm getting on some of these days where I don't have any trades because I either can't get in a 50% because we don't make it there, like this 44.90. Even if I wanted it at 90 and a quarter, we didn't trade at it. Or we're getting so high and we're just not stopping. We're continuing higher, but it's getting kind of risky up here that I don't want to take a trade at highs. So how can I get in early and stay in? I looked at 1 minute bars, 5 minute bars. How can I get in right off the open and manage my risk? If it's going to be a trend day, run with it. So we essentially got to go another 2 points off of highs to get a 20-point fill and kind of getting that bull flag again. A bigger body and then 3 bars and then break out. Bigger body, in this case inverted hammer, maybe 2 more bars to get a breakout. And yeah, the 4 point stop is just for the 15-minute chart. When I'm taking a retracement on the fibs, I'm using a 2 point stop. If things got incredibly volatile but were pretty technical, or I wanted to trade retracements, you could double your stop to 4 points and then double your first target to 6. But by and large, even if things get wild, we tend to trade nice and cleanly off of 50%. So if they get so crazy, like at the start of the pandemic, I would just take a few days or take the week to just sit back and observe and not try and trade it. Kind of take some time to make sense of things and then work my way slowly back into trading. The other thing about a bull flag is oftentimes, that halfway point of the bar is where we reverse to. So if you just look at the bigger body here, I know you wouldn't normally draw a retracement like that, but just to get a sense of, okay, where's the 50%? Well, they're actually at it. And then the 60-18 is, just call it 44.96. That's kind of the halfway point of that bull flag bar. So sometimes you can get faked out into thinking, oh, on the 512, this looks like a short, but that's where keeping that 5 minute next to you and reminding yourself, okay, well, we've gotten one bull flag, two bull flags. What's from stopping us from having a third bull flag? This 4,500 is a nice big round number, which is could be a good resistance point, but in our breadth advanced decline line have come down a little bit. So there's a few little signs of a potential reversal, but I'm not going to just throw in the towel because of that. As far as the VIX is concerned, we were talking like VIX 45 plus, talking like this kind of stuff where you're like 45, 50 and above. Initially it's okay, sit on your hands, observe, don't make any stupid decisions. If you want to buy, add to it, do a long-term add on something like that, no big deal. But then when things start to come down a little bit, okay, we're in this 40 to 50 range. All right, things are looking more technical. Let's look at placing some trades. Let's cut our position size in half, but we'll keep our risk the same, or that will keep our risk the same. So we can still be actively trading and not getting burned. All right, let's see if this push can get us there to, really it needs to go to 83, 75. Every once in a while, price will touch my order and you get a fill. We call those magic fills, but maybe 2 in 100, 1 in 100. Doesn't happen very often. Kind of got to be first in line. That's pretty bearish. Peaking above by 2 ticks and getting pushed down fairly hard. Let's see if it pushes up at this 50%. Again, we're sort of in that tug of war. We're holding the bull flag, but we just poked into highs and we're like really push down, 2 points immediately. And now you have the topping tails in the other direction. So back here, we had a bottoming tail. Price came down. Bulls said, nope, I want to buy it. And they outweighed the bears and pushed it back up. Then bears sold off. Bulls pushed it back up again enough to break out. And then did it again. But then here, bulls are kind of losing steam, pushing it up. And then bears saying, nope, I want to take a short or I want to take profits. More likely take profits. And that position is bigger than the bull position. So if you think of it as that tug of war, one side is starting to lose. And I mean, we have not made a 50% touch since that very first one here. Oh, there we go. Yes. So let's move our stop to a 94. So that's a nice big push up. Gives you 10 points locked in. And if we can go a little higher, get that 20 point, great. But at the very least, got my stop now. 44.94. So that's down here. Doesn't look very far away, but it is. If we traded at 44.94, the logic is that we have then broke the low price of the highest bar in the bounce in the rally, and that would sort of be signaling the reversal. Let's see if I find a. So like you come up, you break below the high bar here, and you get these red bars you sell off. Well, I don't want to ride it all the way back down like that. I'd rather just have my stop up underneath the candle's low and then get out. So I mean, even with one, if you're doing a plus 20 minus 4, you don't necessarily need multiple contracts to trade it. You wouldn't trade it any differently. So even with just one contract, one mini at 10 points, that's $100 or $200 risk, $500 gain at this point locked in. So that's all right. this third candle here of like the third candle after the push up, now we've got 3 candles sideways. This is where I would expect the breakout to occur if it's going to happen into new highs. Otherwise, the bull flag will just sort of break down. We'll roll over and maybe towards middle of the day make our way back to the halfway back of the day, which is still just above the top of the 30-minute range, which would be here. So the halfway back long for the day would look something like this. I typically don't stick around and wait to trade that, but this is all we really have for a retracement on the 5-minute this morning. This candle's low. Not really any. So once this candle closes, I would not tighten my stop underneath its low because it didn't make a new high. It's really, at this point, it's just an inside bar. So I'd have to wait for the next candle to form, make a new high, and then close. But realistically, if we make a new high, going a point and a half would get us that 20-point fill. So that would be the more likely scenario. We'll see what happens. And that's just something by years of observation. When you are inside a candle, inside a daily, let's see if I can find an example. Nothing's really standing out. But oftentimes, if you're inside a bar, and this one is not a good example. That one, yeah. Let's see here. Yeah, nothing really is very striking. Leaving your stop below the breakout bar is basically the idea here. You consolidate for 4 bars and then move higher. If I see a better example later in the week, maybe I'll touch on it in the next video. I think I might move more to a like a market analysis / trade recap video in one. Sometimes there's not a whole lot of change week over week to do a super lengthy market analysis video, and I suppose I try to keep them as concise as possible, but sometimes when I'm running through the trades for the week, they can get a little bit long, and I'm trying not to run through and talk so fast. I know a lot of folks are probably watching it on 1.5 speed to speed it up as it is. So, but yeah, I'm just trying not to dump too much video content out there. I know it becomes kind of overwhelming, all the stuff out there on YouTube. There's some awesome stuff, and it's amazing. I've said this before, how you need to fix a certain kind of faucet or a certain model of a thing. You can probably find a video exactly how to do that and save yourself some trouble, or at least it's kind of a way to brief yourself on what you're going to be working on. But then there's a lot of other junk out there that gets you sucked in and never delivers on what it said it was going to do. And to be honest, I don't really want to be doing massive video production 5 days a week and just the time that it takes. I probably could spend more time with better video quality and picture in picture with videoing myself and all the other stuff that's out there. But the main idea is just to get some of the trade highlights from the last few days so that you can make some applicable decisions or adjustments going forward. Okay, what's working, what's not. Let's do more of what's working and less of what's not, and try to learn from the most recent experiences and then add those to our experience bank so that they become ingrained in our heads so we make sure we don't make certain mistakes again and we can always be moving forward. If this low does end up being the low, which I do not think that is the case, but um, that would be quite a surprise. Go out to a monthly. That's what the monthly retracement looks like. Big, almost traditional retracement at the uh, pandemic sell-off, and then an extension high to high here. I did put in the Discord Ray Dalio's new video, that Changing World Order. Definitely worth a watch. Some really interesting historical, just history in the video, talking about the changing of world powers and different trajectories on how kind of the business cycle expands and contracts, but then over a longer period, these different economic powers come into play, the U.S. being the dominant one at this point, but how the various wars we've been in, breaking the bull flag here now, various wars have influenced the outcomes of the wars have had a big impact on kind of who is in power, and China is certainly um, knocking on the door as we are being threatened with all this war stuff. So always good to get some different perspectives. It's not really a doom and gloom video. It's just more of a, here are the different powers that have been in play over the last few hundred years. And then his other one that I'm sure you've watched because we talked about it, the how the economic engine works, is another really good video talking about the boom and bust cycle and expansion and contraction and things like that. It just, as we know, history likes to repeat itself, and most people's emotions get the best of them at the worst times. And I think Annie Duke is actually coming out with a new book. I really liked her book, Thinking in Bets. That was very applicable to trading. And then her next one, How to Decide. That one was pretty good. More about making bigger decisions and kind of a roadmap for making decisions. So that was worth a read. It wasn't as exciting to read, but applicable. This new one, I'm not exactly sure what the topic is, but I like her writing, and they've been pretty applicable. Yeah, for that Discord, I'm not super familiar with Discord. I thought I had the link to the Discord channel in the dashboard. So now not really an opportunity to tighten our stop. I'm just going to leave it at 94 and see what happens. If we make it to the plus 20, great. Otherwise, take that plus 10 and go about the day. Let's see here. This Discord thing. So the Discord link has the channel and then the long channel number. At one point, when I first started it, I made it private, that you had to be invited or at least click a link to get in. And here we go. So 94. So plus 10 and change. Not bad. Would have been nice if we would have ticked just a little higher, but I'll take it. So at this point, then, likely get a slow grind to that full halfway back. So I'm going to paste two links in here. One is the link that I use, or that I just have bookmarked. Hang on a minute. And then the other one, so this one here, the second link. Yeah, and that could be it. So at first, I set it up and I had set it as a private group. I wasn't super familiar with Discord. And then I just took that off and made it open. But this is the link that I click on, and obviously I have a Discord account and I'm signed in, and I click on that link and it takes me there. So if you still have trouble, you can shoot me an email and I can play around with it a little bit more. And maybe there's a better platform to be able to chat throughout the day, but it is nice to be able to drop some screenshots in there, have a few, different discussions going without being super overwhelming. I don't use Slack or any of those workflow programs, so I'm not kind of in chat all day, and I don't really care to be. So, but if you have suggestions or have any ideas on that, let me know. I'll look into it a little bit more as well. So, but I think that's a good uh, stopping point. If you do have questions, tim@eminimind.com. You can always shoot me an email, and happy to chat more. So thanks for tuning in today. I will talk to you all soon.